not flying by the seat of our pants. We're looking at hard statistical information. We're calculating our odds, and we're making our bet. We're taking a moderate risk, and we're expecting what I would consider a reasonable profit given the range of the day. See? Hopefully you see the power in that. So now our money management can take on an entirely different look. Maybe you don't want to use 3 and 7. Maybe you want to take 8 off at 25 and then 2 and take off 2 if the market gets to 95. Well, if that's what you want to do, then you know, okay, well, then if it only wins 40% of the time, then I'm just not going to make money over time, and I really need to be up here at 55 or 60%. So what that means is, with that particular trade where the market's it's had a big run, it's near the top end of the daily range, and it's at the top of the trading lane for the day with a similar scenario, what do I expect to make over time? Do I expect to make 55 or 60% of my trades as winners, or do I expect 45 or 40% at winners? So if you want to prepare for the lower end, then you can adjust the numbers accordingly. Maybe let's look at 5 and 5. So we take 5 off at 25. We take 5 off at 95. Okay, you know what? Now look at that all the way down here. Even if I'm only winning 40% of the time, that means I'm at least marginally profitable. If I can bump that up to 45%, look at that. That's a pretty good, and if it's a pretty good win rate, or a pretty good profit ratio there, and if I'm down here at 50%, whoa, now that's a really good system. For every buck I put in, I make $1.20. So again, you can play with the numbers and have a very good idea of what to expect for a specific kind of trade. Now I want to tie in the second part of that expectancy equation that I did, and this is where we plugged in multiple systems. And maybe some of you were wondering, well, I didn't really get that, and how does that apply to real trading? Well, let's say that over time, you take 6 of these trades. Let's just look at taking this one trade. Let me scroll back quickly here. Let's say that you take 6 of these trades where the market, is in a trading lane, and you're just taking a whack at it. Let's figure out. Let's see what happens and see if we're going to make some money. Well, if you take 6 of these trades and you have this mix of win rates and these profit targets with a static loss at 35 pips, what you'll see is that over time you'll actually make some really good money. So for every $1 that you put in to this mix of systems, you'll make $1.46. That's a very good system. In fact, some of the best systems in the world are about $1.50. So the mix of systems is on par with some of the best traders in the world. But I want you to look at something. That's not winning all the time. Look at that. That's taking trades that win 35, 45, 35, 45, 33, 47. Okay, these are not big winning systems. It's simply that you're making sure that you're letting your profits run. Now, I realize that this doesn't take into account multiple exits or anything like that. It's just a very general picture, but it's useful. It's useful in that you can see that the most important thing is going to be for you to control the amount of money that you're winning. We can keep our losses static. Okay, the losses we take care of. You pull the trigger, you get out of the trade. As long as you're letting your profits run,